Mutual funds are winning, the industry is booming, markets are delivering strong returns. But here's the uncomfortable truth: most investors are still losing money.
Stock market is going up, but my mutual funds are not. Market 15%. My return only 5%? What's going wrong?
This is what I call the mutual fund paradox. In this video, I'll show you why this happens, uh, the biggest mistakes investors make, and how you can actually fix it. Let's start with the big picture. India's mutual fund industry has exploded in size. AUM has grown to 82 lakh crore by 2025, and SIP inflows are at record levels, 31,000 plus crore every month. This means more Indians than ever are investing. Everything looks perfect. But here's the question: if the industry is growing, why isn't investor wealth growing at the same pace? Now let's look at markets. The Nifty 50 total return index has delivered around 14% CAGR since 1999. And here's something even more powerful: markets gave positive returns in 17 out of 22 years. That means if you simply stayed invested, you would have created massive wealth, but that's not what happens in reality. Despite strong returns, investors exit at losses or settle for very small gains. So the real problem is not the market, it's investor behavior. There is something called the return gap. A study showed last 1 year, market returned around 7.8%, but investors earned only 3.5%. Same market, same opportunity, but very different outcomes. Why? Because of timing mistakes. Here's the truth: most people ignore investing is not about intelligence, it's about behavior and discipline. As Warren Buffett says, the biggest enemy of the investor is himself. Your emotions, fear, greed, impatience destroy more wealth than the market ever will. Let's listen to Warren Buffett.
People behave very peculiarly in terms of the reactions because they're human beings, and they get excited when others get excited, they get greedy when others get greedy, they get fearful when others get fearful. Investors behave in very human ways, which is they get very excited during bull markets, and when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say this is a lousy place to be. So they don't care what's going on in the underlying business, and it's astounding. But that makes for huge opportunity.
First mistake: buying high. Data shows that 85% of money comes in when markets are expensive. Why? Because people chase past returns. When markets are rising, everyone wants to invest, but by then, most of the gains are already gone. Second mistake: panic selling. In 2009 or 2020 COVID time, when markets crashed, investors exited at extreme lows. But what happened next? Markets recovered massively. So what did investors do? They sold low and missed the recovery. Third mistake: too many funds. India has nearly 1,000 mutual fund schemes. Most investors end up buying 5 funds, 10 funds, sometimes even more. Result: no clarity, no focus, no real return. Fourth mistake: no strategy. Random investing based on tips, news, or price movement. Studies show that 90% of people using mechanical systems lose money because there's no plan, just reactions. And then there are hidden problems. Cost, commissions. Most of the time, bank relationship sell their client to meet their target. Wrong advice, mis-selling. It's like carrying a bag of money with holes in it. Slowly wealth leaks away. Now, here's something interesting. Most investors who invest alone struggle. Um, in fact, studies show that a large percentage of investors lose money when they act on their own, because investing is not just about picking funds, it's about staying invested. This is where a good advisor adds value, not by giving stock tips, but by controlling behavior. They stop panic selling, maintain discipline, ensure proper asset allocation. Even simple strategies like SIP, when done consistently, can outperform random investing. Advisors are most valuable when markets fall. When fear is highest, they act as a shock absorber. They keep you invested when your emotions want you to quit. So, what's the solution? Simple. Focus on time in the market, not timing. Follow a long term approach. Use SIPs to handle volatility. And most importantly, control your behavior. Because in investing, mutual funds don't fail investors, investors fail themselves. Now, if you really want to understand how to beat the market, I've created a 5-page report called The Mutual Fund Paradox. It covers proven strategies, asset allocation, risk management, and how to avoid these costly mistakes. You can download it from the link in the description. And if you found this video valuable, don't forget to like, share, and subscribe for more real investing insights.
If you liked the video, let's grow together. Share this video. Subscribe for more. Thank you for watching.